SUERF, the European Money and Finance Forum, bringing together policymakers, finance, and academia.
Welcome to this SUERF-BAFFI Bocconi e-lecture on key insights from the IMF's April 2025 World Economic Outlook, Global Financial Stability Report, and Fiscal Monitor. The global economy is currently facing strongly elevated uncertainty, while it continues to grapple with slow-moving, longer-term challenges. What are the implications from shifting policies and geopolitical developments for the outlook on economic growth and inflation? What are implications for public finances and the financial system? What are potential risks for fiscal sustainability and financial stability? How should fiscal and structural policies respond in a situation of already stretched public debt levels? What route should monetary policies take in this uncertain environment with underlying vulnerabilities and a complex interplay of demand and supply shocks, some of which may be of a longer-lasting nature? The IMF's trio of flagship publications, the World Economic Outlook, the Global Financial Stability Report, and the Fiscal Monitor, shed light on these and similar questions twice a year. The latest trio of these publications was released a week ago. Today's e-lecture brings together their authors to present key messages. Let me give a warm welcome to Deniz Igan, Chief of the IMF Research Department's World Economic Studies and SUERF Vice President. Deniz will highlight key findings of the latest World Economic Outlook. Then, Jason Wu, Assistant Director at the Monetary and Capital Markets Department of the IMF, will present key findings from the GFSR. Third, Davide Furceri, Division Chief in the Fiscal Affairs Department, will explain to us key insights from the Spring 2025 IMF Fiscal Monitor. Now, handing over to Deniz, the headline of this World Economic Outlook is "A Critical Juncture Amid Policy Shifts." What are main takeaways of this World Economic Outlook edition? Over to you, Deniz.
Thank you, Ernest. So many thanks for the opportunity to present our views, our latest views on the global economic outlook. And this presentation that I will be giving draws on work by many people through the entire IMF, including research economists, but also country-desk economists and our economic modelers. So if I were to summarize what's shaping the current economic landscape and outlook in one word, that word would be uncertainty. And a great part of this uncertainty is stemming from major policy shifts that we have been seeing. Now, following an unprecedented series of shocks, starting with COVID, but then the war in Ukraine, global growth was actually quite stable, although it was underwhelming through 2024. That landscape swiftly changed as governments around the world are now reordering their policy priorities. Now, that critical juncture that we're describing is coming from two factors. In the left-hand side chart, you're seeing the effective tariff rates that U.S. applies to its trading partners. As you can see, we are now at levels as of April 9. We are at levels that we have not seen in a century. And on the right-hand side, you can see the different metrics of different indicators of uncertainty, and particularly the red line that you see there. This is the trade policy uncertainty, is literally off the charts. Now, these two factors, uncertainty and the tariffs, are testing global resilience. Now, I'm going to quickly go over the recent developments that we have seen, and then move on to our outlook. Now, inflation has been coming down. Actually, our October version of the World Economic Outlook was touching on that we were finally seeing this soft landing in many economies. And that trend actually since October pretty much continued. It has not been a smooth ride. We have seen bumps here and there, but globally speaking, inflation has been coming down. And at the same time, we have seen labor markets normalizing. That has been a feature of the pandemic. But in almost all countries now, we have unemployment and vacancy rates pretty much at the levels that they were at the end before the pandemic. And against this background, growth has been hovering around 3%. That is still lower than what we had seen in the decade before the pandemic, but still it was a stable number, and global output looked like it was quite close to potential as of 2024. Now, that's not to say this global outlook, global features apply to all countries. There were differences across countries, and a couple of indicators basically illustrate that in a quite precise way. First, on the demand or more cyclical side, consumer confidence has been improving across the globe, but you can see there in the red line, China has been different from the rest. And notably, the blue line, that's for the US, we had also seen a potential reversal in 2025 as far as consumer confidence goes. Now, on the right-hand side, this is more on the supply or structural side. We have been observing a secular shift of industrial production from advanced economies to emerging markets and developing countries. And that has continued. But what has been interesting again is that in many advanced economies, after the collapse during the pandemic, we had seen some recovery, not back to the levels where things were, except for the United States. That's the blue line. It has, United States on that front has performed better compared to its advanced economy peers. Now, in addition to this, normalization, stabilization we have been seeing globally, albeit with quite differences across economies, there are some common vulnerabilities across economies. The first of these is the high public debt that Davide is going to talk more about. But this high public debt is happening at a time interest rates remain elevated, which Jason, I'm sure, is going to talk more about. The important thing here is that as we enter another period of negative shocks to the economy, many countries have already exhausted their available policy space. This is true for fiscal policy, as you can see here. So in the first chart, you're seeing the support that was required first during COVID and then through the war in Ukraine. Many economies provided fiscal stimulus that came at the cost of higher public debt levels, and now fiscal adjustment needs in many economies is much higher than they were. And in the middle chart, you can see that the debt service as a fraction of fiscal revenues have been rising in all country groups. And the right-hand side chart is showing that the real long-term government yields have also been on the rise. And this has been especially true in recent months. We have seen this global rise in term premiums that was exacerbated by the tariff announcements in April. So fiscal space is limited, but so is monetary policy space as well. And why is that? Again, the surge that we have seen after COVID meant that central banks needed to rely on their hard-earned credibility to make sure that inflation expectations remained anchored, and they were successful in bringing down inflation, as I mentioned at the beginning. But that said, we still have inflation expectations much higher than where they were in 2017-2021 period. And that means that central banks may not be able to look through new negative supply shocks if there's a de-anchoring risk. And that's true in many economies. We show on the left-hand side across country groups, advanced economies and emerging markets. But when you look at individuals in different countries, you can see that especially 1 year inflation expectations are much higher than what the central banks are shooting for. Last but not least, and related to the inflation surge we have seen, growth that we observed in 2023-2024 has not been always balanced. What I mean by that is across countries, we talked a little bit, but also within countries, although we have seen GDP growth, we did not necessarily see the GDP per capita growth. If you look at, for example, Germany, you look at Spain, you look at, as shown here, but Australia, Canada, in all these economies, GDP per capita growth has actually been quite sluggish. At the same time, the cost of living has increased considerably, and this is particularly true for salient items in households' budgets, like the cost of shelter, house prices, but also rents, mortgage rates, consumer credit rates. They have all gone up, and that's a squeeze on households. What that means is that, again, in terms of the fragility or the vulnerability, now policymakers will face significant pressure to provide support to the economy if there's a negative shock, because households are already anxious, they are already on edge. And lack of supportive measures for firms and households to weather the negative shocks we are seeing may actually increase the risk of social unrest and weighing support for much needed structural reforms. Now, let me turn to the outlook from here. Typically, for those of you who do follow the WEO, typically we would have a baseline forecast. But as I said, we're in an environment that is very fluid, that is changing very rapidly. And what we would typically have as a baseline forecast is very difficult to come up with this time around, because we need to have a timely, internal, consistent set of assumptions in order to have our usual bottom-up forecasting exercise. And given the difficulty this time around, what we have decided to do is to instead have a reference forecast, and then also explore alternatives to this reference forecast, primarily based on different assumptions on trade. What is in our reference forecast? This is in lieu of our traditional baseline. Basically, trade policies as of April 4. So everything that was announced between February 1st and April 4 is in that baseline. This includes the April 2nd announcements, higher tariff rates, but also a universal minimum of 10% on US trading partners, as well as the initial responses to that announcement, particularly from China, is in that reference forecast. The alternatives we consider is the pre-April 2nd forecast that does not include the April announcements. April tariffs are not here. It still is a bottom-up exercise. So every country does have their forecasts, and we aggregate them. We also have a post-April 9 forecast, and that includes announcements made after April 4, most particularly the April 9 announcement of a temporary pause on the higher tariff rates. But also the back and forth, the escalation of tariff rates between the US and then China is in that post-April 9 forecast. Now, this is not a bottom-up one, it's a top-down model-based forecast. What do we see at the end of it? What are the key takeaways? So our reference forecast basically projects a growth rate of 2.8 for the global economy this year, and 3% in 2026. That is lower in a cumulative way for those 2 years. That's 0.8 percentage point lower than what we had forecast in our January update. Now, if we look at the pre-April 2 forecast, our forecast for both years would be at 3.2, pretty close to what we were saying in January. So it's actually April 2nd announcements and what's followed from there that makes a significant impact on the global outlook. In the post-April 9 forecast, and we're assuming, since this is model-based, we're actually assuming that the pause that was announced on April 9 is permanent. But even then, we do have a forecast that is pretty close to what we have in our reference forecast. And the reason for that is, even though we're assuming permanent pause on the higher country-specific tariff rates. The escalation between the US and China offsets any positive impact on the countries that were previously subject to higher tariff rates. And then that propagates through global supply chains, and global growth still suffers as a result, both this year in 2026, but also beyond that, the medium-term growth is also lower. Now, I'm going to go very quickly on those ones and happy to take any questions you might have. But just to close the loop a little bit, we always make assumptions, not only on the policies, but also on commodity prices when we come up with our forecast. And this year, just to give you a sense, compared to what we had in October, we actually have lower energy prices under our reference forecast compared to October. And higher food and beverage non-fuel commodity prices. And on the monetary policy front, we do have a higher path for the Federal Reserve, but lower path for the ECB going forward in their policy rates. For Bank of Japan, we're pretty much where we were in October. On the fiscal policy, and this is important, we are actually baking in some consolidation in advanced economies. Importantly here, we do have the announcements from Germany, additional defense spending and infrastructure spending that is in our reference forecast. But for the US, we do not have the ongoing discussions that are still being discussed in Congress, the budget resolution that is making its way. But since it's not been signed yet, we do not have that one. So the tables, I will not go country by country, but this is just, again, to give you a sense of you have the global picture, 2.8% this year, but across countries, what does that mean? Perhaps it's just to, the key takeaway is that the downgrade we have to growth is quite broad-based. You can see the revisions from January, and they're all negatives, as you see there. The downward revision for the US is actually quite large. And this is 0.9 that you see there. About 0.4 is attributable to tariffs, and the rest is the elevated uncertainty affecting investment and consumption, as well as the weakening momentum we were already seeing, especially in private consumption in January and February. And for the emerging markets, again, it's a widespread downward revision. China is seeing a 0.6%. What is not being shown here is Mexico is the other big revision. And not surprisingly, these are related to the tariffs that US has imposed on those countries. Now, a quick word on inflation. So we have a downward revision to growth. What's happening to inflation? We have a slight upward revision at the global level, but again, there is quite a bit of variation across countries. And in the left-hand side, you can see for China, that's the yellow line. We actually have not revised it much. If anything, since October, we have come down. So there is more of a deflationary pressures we're seeing in China. The blue line on the left-hand side is for the US, and you see that there's an upward revision for the US, in particular for 2025. On the right-hand side, we're showing the global distribution of one-year ahead inflation projections at different vintages, different WEO vintages. So the yellow one is what we have currently, and what you can see is that compared to the red one, which we had last year this time, it has shifted to the left, so lower inflation or less of tail risks of high inflation, but it's still to the right of the blue line, which is the pre-COVID distribution of inflation forecast. So we continue to be in a precarious situation as far as inflation outlook is concerned. Now, a word on medium-term growth prospects. We have been talking quite a bit about this, and what you're seeing in this particular chart is that current medium-term growth forecast falls short of what we had thought of medium-term growth back in 2020. So the 45-degree line, you see many economies are below the 45-degree line. Now, a key reason for this sluggish medium-term outlook is demographics, right? We have several headwinds, and demographics is a common one, again, across countries. And our analytical chapters actually take a deeper dive into that. Our chapter 2 looks at population aging and how much is expected to weigh on not only growth, but also on the fiscal situation. And our chapter 3 looks at population movements across borders and to what extent policies in destination economies have spillover status. Just to give you a very quick flavor of what those chapters are doing, and they're both very good reads, so I won't do justice just in 30 seconds, 1 minute here, but just to give you a flavor. This is from our chapter 2, The Rise of the Silver Economy. The chapter does several things, documents that actually one silver lining to an aging world population is that people are now healthier at the same age compared to the cohorts that came before them. And that has some benefits, some offset to the negative effects that come from aging. The chapter goes on to analyze the impact of healthy aging on labor force participation, on hours worked, so remaining engaged in the labor market, basically. And it also does some model-based analysis to understand and to quantify what are the gains from this healthy aging, how much benefit they give as far as the outlook and the fiscal balances are concerned, but also there's some thought experiments, some policy analysis. And what you're seeing here is first the healthy aging scenario. So health policies reduce cross-country differences with respect to the frontier of healthy aging by about 1/4. So you get Scandinavian countries, they are a typical Scandinavian at 70 is healthier than a typical 70-year-old in an emerging market, for example. So this thought experiment is that health policies are in place, so that gap is actually reduced by 1/4, and the impact on GDP growth in the long run is shown in the blue bars here, and it can be quite sizable for a country like India, for example, as you see there. And then the second exercise in the red bars is a higher effective retirement scenario. That's basically, it's not the mandatory retirement age we're talking about here. This is the effective retirement age when people choose to quit the workforce. And it looks at policies that could encourage people to remain longer in the labor market. And if you can see again, depending on the country, but the world bar is also there, it can again benefit countries. And the last thought experiment is the gender gaps in labor force participation. If this can be reduced by 3/4 in the next couple of decades or so, and what you get is the yellow bars in that case. And as again, you can see, this can also boost growth. So the combined policy package has, for the global economy, has about 0.3 percentage point higher growth on an annual basis from 2025 to 2100. So these are sizable gains. And this was on chapter 3, so junctions and then journeys. And what you're seeing here is basically looking into the impact of having cooperation instead of unilateral action when it comes to migration policies. And we're showing for the impact of different policy responses in the destination countries, and they tighten immigration policies, blue bars, they take unilateral action. In the yellow bars, we see how much cooperation gets them or how much it costs them. And this is the impact from the destination economy. That's the spillover from the destination countries' immigration policies on the bordering emerging markets, as well as non-bordering advanced economies, because these non-bordering advanced economies are the alternative destinations for immigrants. And the bottom line here is that cooperation does give benefits in all cases, but it's a little bit of a prisoner's dilemma kind of situation, because unilateral action, especially in the short term, is actually better for the economies to take, but in the long term, cooperative action would help. Now, turning to risks, what we have seen since the January update actually is a couple of major risks that we had flagged back then, one of them being escalating trade tensions, have not materialized. So you could then think that this time in April, since some of the downside risks have materialized, risks would be balanced, but that's not our assessment. And the reason for that is, although some downside risks have materialized compared to January, other risks have also risen, they have intensified. What we are seeing on the downside is an even further escalation of trade tensions, even more prolonged and more elevated trade policy uncertainty that would weigh on investment, on consumption, on FDIs, capital flow, everything that would be touched by trade, basically. And what is adding to that is the financial market volatility and correction. We have already seen some correction, first in March and then in April, but still in the US, for example, valuations are quite generous from a historical point of view, so further correction is possible. Further correction in other markets is possible. We have rising long-term interest rates that is costly for consumption and investment activities, but also for the government. So all of those combined could be quite taxing, especially for economies that are already experiencing some debt stress and they don't have much room. So this global tightening of financial conditions would weigh on them, and there's a risk that things can also turn disorderly, given some vulnerabilities I'm sure Jason is going to cover in more detail. The rising social discontent, as I mentioned at the beginning, households are already anxious. We are going through a big transformation, major policy shifts. So there's a risk that social discontent, social unrest is going to rise again, with implications for macroeconomic activity. And what is something new is that we are seeing increasing challenge to international cooperation. This is particularly crucial for low-income economies. So a reduction in international development assistance could be quite consequential for some economies that rely on such assistance, and puts them in a difficult situation where they need to make hard choices on spending cuts or somehow raising revenues, and it has implications, immediate implications for their living standards. And on another downside, important downside, is the labor supply gaps. So as I said, it was no accident there are Untitled Chapters are looking into demographics, they are looking into immigration patterns and immigration policies, because labor supply gaps, especially in Western economies, but also on some large economies in Asia, are there, and the current policies, the direction seems to be that we're going to be seeing more gaps rather than less on that front. Now, it's not all gloomy. There are upsides. Perhaps first and foremost, if we do get a next generation of trade agreements, bilateral, multilateral, regional, that would bring some stability, some predictability to the trade policy landscape, that would already be a positive. In our reference forecast, we have trade policy uncertainty remain elevated through this year and next. So if there are agreements that lift that uncertainty, we would already see, even in the short run, a positive impact on global growth. A mitigation of conflicts in Africa, but also in Europe, in the Middle East, that would be a positive for not only the economies that are experiencing the conflicts, but also the neighboring economies, as well as the global economy, because of the lifting of the risks on global supply chains. And structural reform momentum, given everything that's happening, the shifting policy landscape, could give some more impetus to structural reforms that have been long discussed. And we do see implementation, faster implementation of those policy ideas. We could see an uplift, especially in medium-term growth prospects. And then the technological advances, in particular artificial intelligence, we could have the type of productivity growth boom that could, again, be beneficial for global growth. Now, having said all that, let me take a deep dive into the downside risk that I highlighted, escalation of tariff measures, other restrictions, not only tariffs, but non-tariff trade restrictions, and further fragmentation of the global economy. Now, if you just look at the numbers of trade restrictive measures, 2025, see that we have been seeing more and more of these measures coming in and increasing on services, which is something that we understand less about. And firms are very, very concerned on fragmentation. So what you're seeing on the right-hand side is the count of words that we see in earning calls of a sample of global economies, global firms, and they are very concerned about that. So what could be the implications of that beyond the advanced economies? So typically, in normal times, historically, what we have seen is that when trade policies are uncertain, there are tensions going on, and there's more volatility in financial markets, we will see a dollar appreciation. Also, our traditional trade models would say the tariffing country, US in this case, that kicks in, it would experience its foreign currency appreciate. So a US dollar appreciation could be the books based on this historical experience, and then the global GDP would suffer, especially coming from emerging market economies. And on the right-hand side, you're seeing this not only for growth, but the US dollar appreciation would also have implications for inflation, and the pass-through could be a pass-through to inflation from depreciation of local currencies can be especially high when the level of inflation is already high and uncertainty is already high. We have done in the report several exercises to quantify what could be the impact of different downside risks. We do a lot of analysis of tariffs, short-run effects, long-run effects, and what we do see is that they are bad for growth. For inflation, it's more of an open question, but the impact, the negative impact on growth is especially pronounced when there's higher pass-through from tariffs to inflation. So it depends on the markups of the producers, but also more dollar invoicing means more negative impact on growth. And we have a downside risk scenario where we have global divergences, basically even more spending in the US on the fiscal front, weaker domestic demand in China and Euro area. We add a trade war on top of that, and then we add even more global uncertainty on top of that, and tighter financial conditions all those layers will bring you to the green line that you see here and the green bar for the long term. So we can imagine quite sizable impact on global growth if all those downside risks are realized. Quickly on policies, in this critical juncture, we see basically three priorities. One is restoring confidence and stability, especially on the trade policy front. The other one is reducing imbalances, especially on the fiscal front. And the last priority, but definitely not least, is sustainable lifting growth through structural reforms by making progress on climate policies, on labor market policies. So I'm going to just throw in this one word also. We have a commodity special feature that looks at a very interesting topic, which is the increased demand for electricity from artificial intelligence and what would be the impact on electricity prices. And basically the bottom line of that special feature of analysis there is that with the right policies, the electricity price increase can be low enough. And what are the type of right policies we're talking about? It's basically providing some tariffs on solar and wind so that the additional demand that comes in is met by a supply response from renewable resources. So let me stop here. I went a little bit over, but I hope you got the gist of the report. There's much more, and please download and let us know your feedback. Thank you.
Thank you so much, Deniz, for managing to squeeze the main thrust of the World Economic Outlook in 37 minutes. Congratulations, you managed. Thanks also for giving us a glimpse under the hood regarding your technical assumptions, risks, and opportunities, and so on, positive, negative scenarios. Now, I just want to raise one question put by Professor David Llewellyn. Has the IMF identified any impact that Trump's measures have specifically on poorer countries? Obviously, these countries will suffer from any negative effects on global growth, any rise in interest rates on external debt, denominated mainly in US dollars, and any cut in aid transfers due to negative impacts on the economies of donor countries. But are there more specific impacts on poorer countries? What has the IMF looked at in this context, in the context of your scenarios?
So this is something that we're keen on, and it's together with the World Bank, this is something that we're looking closely into. As far as the WEO goes, we did see quite important downward revisions in low-income economies that are dependent also on international aid. So the reduction in international aid, but also all the channels that David is pointing out there, the tighter global financial conditions, but also weaker growth in the major economies of the world, they're all going to be negative for these economies. I'm going to leave it to the report. We do have a fiscal appendix that has every member country, that we have 191 countries, and we have forecast, 5-year forecast for them.
Okay, thank you very much. We're still on time. Congratulations. Let's now turn to Jason for the GFSR. Jason, you headlined the GFSR with a call for enhancing resilience amid uncertainty. Now, what sources of uncertainty do you see beyond the obvious, and what are possible remedies to enhance resilience?
Thank you so much, Ernest and SUERF, for inviting us here today. I'm going to follow up to Deniz's presentation by presenting a few slides on the Global Financial Stability Report, which is a complement to the WEO by looking at the downside risk, particularly in the financial system globally. And so I think a lot of the GFSR also covers market developments, and I think this needs no introduction. I think after April 2nd, we have seen significant volatility in global financial markets. What's shown on this slide is the performance of the stocks around the world. And as you can see, we're being indexed at 100. in the at the time of the previous GFSR in October 2024, you can see the amount of volatility that the markets have gone through, right, in the past few weeks. And so with this volatility, one observation that we have made in the previous Global Financial Stability Report is the disconnect between uncertainty and volatility. So this slide demonstrates that if you look at the green bars, these were where we were at in the previous GFSR. And you can see that the green bars for the uncertainty measures, whether it is trade, starting from the left, economic policy uncertainty and geopolitical risk in the middles, it's very disconnected from the green bar on the VIX index on the right, in the previous GFSR. This basically tells us that the market was fairly sanguine given the amount of uncertainty that was in the marketplace. What you have seen in the most recent period, especially after April 2nd, was a complete shoot up of the volatility in a catch up to uncertainty. So I'll turn your attention to the red bars here, which is the latest situation with the VIX nearing the 90th percentile historically, compared to the uncertainty index, which are close to 100th percentile. So things are as uncertain as they have ever been. And I think these uncertainty indices are measured, in the Baker-Bloom-Davis type of way, right? So by textual analysis and sort of reading the major newspapers. And you can really see that, the volatility has caught up to uncertainty to a very large degree. So with this happening, right, trade uncertainty, as Deniz has mentioned, has real consequences. So this table here is really picked out from the wheel, and you can see that there's significant downgrades to the reference forecast this time compared to previous baseline forecasts. And I just wanted to highlight that as Deniz has mentioned, for the U.S., for China, and for the world trade volume, these forecasts have been downgraded the most by 0.9 percentage points, 0.6 percentage points, and 1.5 percentage points in particular. And so obviously real consequences in the financial system, real consequences of as a result of the trade uncertainty will have consequences in the financial system as well. And so I want to take a quick detour for the audience who may not be familiar with the GFSR to talk a little bit about financial stability framework and how we think about financial stability assessments in the GFSR. So let me start with this schematic. This won't take too long, hopefully. The idea that, the financial stability framework that we have in mind is basically outlined here. So you have adverse shocks starting on the left. These shocks, whether it is a war, whether it is, COVID, whether it is, a bank failing, when it hits the economy, it tightens financial conditions, right? And then tighter financial conditions is amplified by this block in the middle called macro financial imbalances. This has two categories. One is asset valuations. So things can be either modest or things can be stretched. And we look across different asset classes, including debt, equity, foreign exchange, etc., across countries, country A, country B, etc. And then the second block of imbalances are what we call financial vulnerabilities. These are things like leverage, maturity mismatches, external mismatches, etc. And one can, in concept, make assessment about this for different types of financial institutions, including banks, hedge funds, etc. Hence the matrix structure, right? So the financial vulnerabilities can be either low or high. And so the idea here would be when a shock hits, tightens financial conditions, and if we're in a world with modest valuation pressures and low vulnerabilities, that's the green arrow on the right, then the impact to the real economy, to crisis probability, etc., should be fairly modest. Conversely, if the world is in stretched valuations and vulnerabilities are very high, then the impact would be quite severe. And this is arguably what we have seen during the global financial crisis, for example. So the firm ideas, just to give a few examples, right? What is a banking sector solvency stress test in this framework? A banking stress test is essentially, we specify a certain shock or scenario, as you can see in the purple here, on the average shock. Then we run through the leverage, maturity mismatches, currency mismatches, etc., for the banks, right? And we get to an outcome on capital adequacy of the banks. Okay. So this is how sort of like a stress test can be viewed through this framework. Now, what is an investor risk survey in this framework? For example, the famous Bank of America Investor Sentiment Survey. This is where investors will tell the survey, the many types of shocks that they are concerned about, including inflation shocks, geopolitical risk, etc. And then quite often the investors will also make a comment on how this affects asset valuation, as well as the real economy on the right here. In terms of the GFSR, what we focus on is we acknowledge that shocks are very difficult to forecast, right? But what we might be able to do is to look at vulnerabilities carefully and try to quantify. And hence, the focus here is really on the financial vulnerabilities. And then as well as asset valuations, whether things are stretched or valuations are modest. And we try to make an assessment of what this means for crisis, as well as the real economy. And then finally, something that a key tool in the GFSR that I'll be talking about is so-called growth at risk. This is basically trying to forecast the left tail of growth densities, which is a representation, in our view, of financial stability risk. So, to do this, this is a statistical model that looks at many different past shocks. We feed it through some simplistic and parsimonious representation of asset valuations and vulnerabilities. And it gets us a real economy impact at the end. In other words, a distribution or a fifth percentile, growth forecast of what might happen in the left tail as a result of financial instability. So with this framework in mind, I wanted to give the bottom line assessment to this Global Financial Stability Report in April. Overall, let's look at our financial conditions first. We judge that global financial conditions have tightened significantly. And so what's shown here is our financial conditions indices. This is purely an asset price-based object. So we take into account, more than 40 countries, as well as, a batch of asset prices in each of those countries. And then we look at how they evolve compared to historical average. So when the index is above 0 in this chart, this means that financial conditions is historically tight. When it's below 0, it's historically easy, right? So you would observe that until the October 2024 Global Financial Stability Report, many countries are actually below 0, right? Meaning that financial conditions have been fairly easy, particularly the United States in the green line here. But what we have seen in the past several months is that financial conditions have tightened significantly, and the tightening has really picked up pace since April 2nd. And so we are in a situation right now where a few jurisdictions, including other advanced economies and EMs in the blue and black in particular, are above historical average in terms of tightness. So financial conditions are tight by historical standards. And US has tightened quite significantly from a very easy position. So financial conditions have moved a lot in recent times. And so this is a key ingredient to our baseline assessment, what I mentioned as growth at risk, right? So this is basically something that we anchor our financial stability report on. So this is basically, growth at risk is basically a model where we try to forecast the global real GDP growth 1 year ahead with 5% probability as a function of financial conditions that I've just shown you, as well as credit growth metrics. And so the outcome are the densities that you see on the right here. Basically, during the previous Global Financial Stability Report in October, we're looking at the red density. The fifth percentile of that density was around 1.2%. This means that given the prevailing financial conditions and credit growth metrics at that time, global growth is forecast to be lower than 1.2% with 5% probability 1 year ahead, right? This probability has shifted significantly this time when we move to the blue density. So the fifth percentile of the blue density is now at 0.3%, which means that global growth will be lower than 0.3% with 5% chance. And so this is an almost 1 percentage point decline, right, in growth at risk, signaling that financial stability risks have increased significantly. Part of this density move is also because the WEO baseline or the reference forecast have moved, but also the tail has lengthened because financial conditions has tightened. And so with this, anchoring, with growth at risk, we then try to corroborate, with qualitative analysis. Okay, do we see, vulnerabilities in the financial system that supports this story that financial stability risk has increased? And so the answer is yes. And I will highlight three vulnerabilities in particular. One is that further asset price corrections are possible because valuations in a number of asset classes is still high. And we also live in an extremely uncertain environment, as Deniz has mentioned. So many shocks can unravel, asset prices and lead to corrections. Second is that financial institutions, some of them could come under strains, especially the highly leveraged ones, particularly certain non-bank institutions, which I'll get to. Third is that there could be further turbulence in sovereign bond markets. There are high debt levels in emerging market economies in particular, and there are market functioning issues in core sovereign bond markets, including the US Treasury market. So the rest of my presentation will go into each of these themes. In terms of the first vulnerability, further asset price corrections, this chart is very telling. Okay, so this basically shows the percentile of asset valuations across US equities, technology equities, US high yield, and European high yield bonds. As you can see in the previous GFSR in October, we're at the hollow dots, right? So with the equities, US equities and tech in particular, close to 100 percentile in terms of valuation metrics. And this is based on our equity risk premium model, as well as forward PE, price to earnings ratio models. For corporate bonds, they were close to 80 to 90th percentile for the US and EU high yields. This is based on a corporate bond misalignment model, which everyone can read more in the GFSR. But the hollow dots have, of course, given the sell-off that we have experienced, moved towards lower to the red dots, which is the current valuation around 75th percentile in general, right? The message here is, despite the pretty violent sell-off that we have seen over the past month or so, valuation is still very high, right? It's still around 3/4, right? Higher than historical experiences. So this suggests to me that in an environment where news and uncertainty can turn on a dime, there could be further pressure in many of these asset markets. And so when that happens, this will be particularly challenging to emerging market financial markets. So here on the left here, I show a very striking chart to us, which is the amount of cross-border flows that have not gone into the EMs, which is basically the blue line here, for EM ex China, and the green line for China, but have instead gone into the US. This is measured by cross-border mutual and ETF fund flows. And you can see that a lot of this have come to the US over the past 3 years, which means that EMs have generally struggled, right, in obtaining external financing. And so in an environment where asset prices tightens and financial conditions tightens further, this would be particularly challenging for EMs. And in particular, at the fund, we also worry about the so-called frontier economies. These are the weaker emerging markets, which, as you can see the chart on the right, has billions and billions of dollars of debt maturing in the coming quarters. This is especially the case for Africa in red, as well as Latin America. Okay, and so this large amount of maturities coming due in the next few quarters is a result of strong issuance immediately after COVID, when interest rates globally have been cut to zero, and a lot of these countries went out and borrowed heavily. So Ernest asked me to talk about geopolitical risk as well. And so geopolitical risk can obviously be one type of shocks that can trigger asset price sell-offs. In Chapter 2 of the Global Financial Stability Report this time, our colleagues looked pretty carefully into how geopolitical risks are priced in financial assets. The overall impetus for this work was that the notion that geopolitical risk only has temporary impact on asset prices in general. And so is there more to it behind the cover? And so what they found is that in terms of both stock prices and sovereign CDS premiums, if we think about asset prices in, along those two dimensions, then, it is true in general that geopolitical shocks will have limited impact, right, on asset prices. So you can see, for example, in the green bar, that a 1 standard deviation increase in geopolitical risk will lower stock prices globally by about 1%, right? So not too large. However, they also uncover an interesting asymmetry in that emerging market economies in the yellow dot will suffer larger stock price declines and CDS premium widening than the overall sample. And so, for example, with the same geopolitical shock, you will see that EM stock returns decline by 2.5, almost 3%, right? And another asymmetry that's interesting is that this is not true across all EMs. So different EMs have different types of vulnerabilities, which amplifies these geopolitical shocks' impact on asset prices. So on the right chart here, you can see that EMs with poorer fundamentals in terms of public debt to GDP, that's the first set of bars, international reserves adequacy, that's the middle set of bars, and institutional quality, right, have especially large impact on CDS spreads, given their trading partner, if their trading partners are involved in international military conflict. And so the way to read the chart is that the blue is like the median impact, on the median EM, when there is when their trading partner gets involved in military conflicts. The green is the additional impact if the EM is above median when it comes to public debt to GDP ratio, when it comes to reserve inadequacy, for example. So this exercise is very interesting in telling us that there's asymmetry, right, in terms of how we should think about geopolitical risk impact on asset prices. EMs are especially vulnerable. Vulnerable EMs are especially vulnerable. Let me move to the second key vulnerability that I mentioned before, which is that some financial institutions might come under strains, particularly non-banks. So here, admittedly, our data quality is not super good, right? Non-banks is notoriously opaque. We cannot really pinpoint individual non-banks that necessarily will get into trouble in this very volatile market environment. However, we do know that when aggregate leverage is high, right, this is not very good, right? So on the chart on the left here, we see that we show hedge fund gross notional exposure to net asset value for the hedge fund industry in aggregate. As you can see, some strategies, including macro and multi-strategy in orange and red in particular, have increased their leverage significantly over the past 10 years. For macro funds, they have gone from 15 times leverage to 45 times leverage, right? So undoubtedly, to our minds, there will be weaker institutions who are very levered up in that group that might come under strains and, amplify, the types of financial shocks that we are worried about. And so looking a little bit on sort of like the type of leverage that they obtain in the chart on the right, here we only have exposure on the type of leverage through what banks report to us, right? So banks lending to a hedge fund in different types of loans we can see. And so we can see that, both equity margin loans in the red as well as fixed income repos in the green have risen significantly to, about $6 trillion in total, right? This is the US only. So US hedge funds borrowing from US banks, $6 trillion in terms of margin loans and fixed income repo. And the black line is interesting because as the share of equity margin loans have gone up, collateralization rate, in other words, the collateral that's held by these banks to lend the money to the hedge funds has also come down, right? Equity margins and repos have recently, moved into a direction where collateral is less. This means that if a shock were to impact, this basically corroborates the idea that hedge funds are highly levered. And when a shock hits, you have to wonder how much damage this will do to the banking system as well. So this could indeed spill over to the banking system. If we take a step back and look at how banks are exposed to non-banks, not just hedge funds, but also, asset managers, insurance companies, as well as private equity and private credit funds, we can see from the chart on the left that bank lending to non-bank financial institutions as a percentage of the core common equity tier 1 ratio has reached 120%, from about 20% 2 decades ago to 120% of the CET1 capital. And so this is really a very strong increase in the nexus between the banks and non-banks, especially in the US. Bank borrowings, private credit firms has been in the news a lot. These are basically opaque, entities that lend directly to companies. They have gone from nothing to $2 trillion in size over the past 10 years. And you can see that, for one type of private credit firms, the so-called business development companies, BDCs in particular, some of this growth has been driven by, increases use in, lines from banks. In other words, they borrow from banks and then, in a way, on lend directly to the borrowers that they need. This has basically gone up by ninefold, right, over the past 10 years. So the banks borrowing from, private credit borrowing from banks have gone up by ninefold over the past 10 years. So the nexus between banks and non-banks has increased, and this makes us worry that, should some weaker non-banks fail, this will spill over to a banking system as well. The last vulnerability that I'll discuss is sovereign debt, and I'm sure that Davide will go into this in his fiscal monitor presentation as well. But I think we've been worried about this for some time. So the chart on the left here makes it very clear that in G3 government bonds, because QT is going on, the percent that's held by private investors is projected to go up significantly over the next few years, particularly in the US as well as the Euro area. If we take a closer look at the sovereign sustainability in EMs, as we do in the chart on the right, we see that many EMs are now in the situation where they the interest expense to revenues has increased. That's measured in the horizontal axis, comparing 2025 to 2027 versus before the pandemic, 2017 to 2019, right? So this is measured in percent of GDP. So take South Africa, ZAF, as an example on the right? If you look at South Africa, this tells us that the change in interest expense to revenues has been increased by 8% of GDP, right? And on the vertical axis, this measures the gross financing needs of the country. And so taking South Africa, not picking on them in particular, but as an example, you can see that the gross financing needs has increased by almost 4% of GDP, for the same comparing horizon. But what's striking about this chart is that when it comes to interest expense to revenue changes, everybody is in the positive territory, right? Which means that no country, no EMs in this sample has been measured to have lowered their interest expenses to revenues. And so this perhaps is a result of higher interest rates globally. Let me finish with one more slide here, which is that, when it comes to sovereign risk in advanced economies, we're worried about maybe something else, which is the market functioning, right? So during, after April 2nd, we have seen the swap spreads in the treasury market decline significantly. So the top charts here shows you the swap spreads over time. And notice that mostly it's negative. This suggests that treasury cash bonds have carried negative convenience yield. People, investors prefer swaps than actually holding on them on. There are a number of reasons about this. The BIS has a very nice piece in September about this. It's a global phenomenon. It reflects that holding cash bonds requires balance sheet capacity. It requires, it runs into regulations, and there are other reasons about this. Hence, the swap spreads have been negative for some time. But what's striking is the abrupt and sudden decline of the swap spreads in April, right? So along with the tariff announcements, you have seen this discrete decline in the swap spreads into more negative territory, suggesting that functioning has become even more problematic in those markets. We have seen some recovery since, but I think they have swap spreads remains quite a bit more negative compared to where we were before the tariff shock. And so you can see some of this in the speculative positioning in the treasury market as well. In particular, we have leveraged funds in the blue on the bottom chart accumulating large amounts of treasury short positions in futures markets in the so-called basis trade, which has been well documented in the press right now. Basically, they were trying to arbitrage the yield difference between the futures market and the cash market. The way that they do it is to obtain massive amount of leverage on the repo side on the one hand and on the futures side on the other hand. And so the unraveling of these trades is a distinct risk for the treasury market in particular. And so some of the other vulnerabilities that we look into and document in the report, although we don't think these are like the top three key ones, are corporate quality, credit quality, which is still solid, but trade policy uncertainty is challenging firms, especially in emerging markets. We also look at private credit borrowers coming under more pressure. In terms of households, their vulnerabilities has increased because they have elevated holdings of equities, at least compared to prior to the pandemic. Many households have increased their exposure to stocks because they were chasing after returns. And at a juncture like this, when the market is very volatile, it makes them more vulnerable. And finally, asset class that has been quite problematic in the recent past, the commercial real estate sector, things have stabilized a little bit, but headwinds do remain in that the sector remains very much debt-driven and have high leverage. And so, Ernest, let me conclude by giving a few policy recommendations. As you mentioned, the title of the report is Enhancing Resilience Amid Uncertainty. It is easier said than done. Let me just preface that way. We can only offer high-level, cross-country advice in the GFSR, but obviously a lot of the devils is in the details of how countries can implement them. And so a few advice that we are giving includes prepare and manage to mitigate risk from severe market turmoil. This includes making sure that central bank liquidity facilities are ready for deployment. It is important, given the leverage that we see in the non-bank sector, to make sure that banks are protected. The core of the financial system should remain safe. And this requires us to implement international prudential standards, including Basel III. There are also FSB measures aimed at mitigating risk on non-bank leverage that we are very much in agreement with. Enhance multilateral surveillance and global financial safety net. This is especially important for the frontier economies and the weaker members of the IMF. And of course, Davide will discuss this more in much more details. Build fiscal buffers credibly. As you saw, sovereign debt levels are quite high, and so this is very important. And in terms of Chapter 2, where we look into geopolitical risk, we think that financial institutions and authorities should identify, quantify, and manage geopolitical risk while holding adequate capital and liquidity buffers, particularly among banks, and then develop and deepen financial markets to help investors manage geopolitical risk. In other words, create hedging instruments and other markets so that investors can diversify the risk of confronted by geopolitical risk accordingly. So, Ernest, let me stop here and happy to answer some questions.
Thank you very much. This was really a very rich presentation, which provokes a lot of thinking. I think I would like to start with maybe three short questions. The short ones are always the most difficult ones to answer. First one is a specific one, whether the IMF has looked into the impact on trade credit from the turmoil. The second question is a bigger political theme, which is actually originates from the US, but which is gaining momentum in Europe as well. And the question is, how does the call for regulatory supervisory simplification, as we call it in Europe, maybe in the US they would call it financial deregulation, how does this square with the need to build up resilience and buffers, as you just pointed out in your last slide? And then the third question is a very big question, it's very speculative. I'm aware that you can't give a good answer to that. It's also maybe a bit addressed to Deniz. It relates to the topic. So if we're in a sort of trade war or tariff escalation period, now this so far relates mainly to goods, but Deniz showed in her slide that it also relates to services. Now then it's just a little further step to financial services and to financial flows. So is there any thinking in the IMF about risks to the free flow of capital? Know that tariffs might also then, as a further consequence, lead to the buildup of barriers to the free flow of capital. So let me stop here and throw this at you.
Thank you, Ernest. I'll be quick in responding to these questions, and I think the last one requires a joint effort with my colleagues here as well. In terms of trade finance, we haven't looked into it in too much details, but we did mention the scale of trade finance in the latest GFSR. It's a $10 trillion market. And interestingly, the $10 trillion measures basically trade finance and supply chain finance from banks through letters of credit to exporters and importers, right? There are also a lot of internal financing apparently among these companies, and these are measured in $20 to $30 trillion. Basically, in the vertical stack of companies along the supply chain, they supply each other with financing, right? So trade finance defined more broadly is more than just the $10 trillion. And I think banks have been deriving significant revenues from trade financing. So obviously, in the extreme scenario that we might be thinking about, if there's a trade collapse, then trade financing is going to hit on banks' profitability. The question is whether banks will have non-performing loans, right, as a result of the trade disputes. And I think we need to do more work to answer that question. I would, however, make the observation that during COVID, a number of regulators and central banks have actually provided loan deferral programs on trade finance, in particular in Asia, and some of those same central banks are now rolling out the same programs again. So it does seem like that there are some pressure, in the trade and supply chain financing landscape. In terms of supervisory simplifications, we can only comment on things that have actually been formally introduced. So far in the US, it has not been introduced, with the exception of something about stress testing. But the stress test itself is not a global standard, right? It's not part of Basel III. So our view remains, as I mentioned in the last slide, that we should have consistent and timely implementation of globally, internationally agreed standards, including Basel III. I think recalibration of regulations to enhance credit provisioning is reasonable, as long as it doesn't compromise the internationally agreed with standards. And finally, on your point about capital flows, obviously this is something that people were quite worried about during the spring meetings as well, with capital flow being the mirror, right, of trade flows on the balance of payments. Will it be now hindered? Again, we have not seen anything, and my base case at least is that there won't be any major capital flow hindrance, particularly given the importance and size of markets in Europe and in the US. And so we cannot really comment on potential policies as well. But so far we have not heard or seen anything too concerning. I don't know if my colleagues have more to add on this point.
Just maybe to add, it's going to be an important part of our surveillance going forward to see what other type of non-tariff measures are being imposed on services trade, maybe not financial, but also other type of services, and also expand our analytical toolkit to understand better. Right now, our hunch is that two things. One is sectoral impacts are important, regional impacts are important, and we need to look at more and more granular data. And the other one is non-linearities. So a measure may look just conspicuous, but then the impact can be really disproportionate. That's one lesson we learned from COVID. And this is something that we're investing some more resources to have model-based analysis to capture this type of non-linearities.
Thank you, Deniz. Meanwhile, we have received another question for Jason, which says, the last column in the framework you presented initially was about cyber risks and interdependencies. Do you see any changes here over the last years? Are banks disentangling due to the trade war risks? And if I may add to this, we're all under the impression of the news from yesterday's electricity failure in a quarter of Europe, let's say. I mean, so cyber risk or risks due to electricity failures, also for banks and financial infrastructure, are also a big theme. Has the IMF done any work on this?
Yeah, thank you for that question. So, Ernest, we actually have a chapter in October last year dedicated to cyber risks in the financial system. And I think, it points out that cyber attacks have been, I can't speak to power grids, which I hope that the disruption in Europe is now restored. It doesn't seem like it was cyber risk related necessarily. But, in the GFSR, we focus on the financial system. And there are two observations. One is that cyber risks to the financial system and institutions have become a lot more prevalent and frequent. Second is that the losses, right, financial losses as a result of these cyber attacks have also increased in scale. And in particular, there could be financial losses that are indirect in nature, meaning that the attack is on Bank 1 and Bank 2 feel the financial losses because transactions with Bank 1 were disrupted in some ways, right? So I think the chapter, don't have the time today, but it does a very good job October last year in laying out these type of cyber risks. I think one thing that the sort of financial stability community globally can do better is to understand the vulnerabilities to cyber risk, right? So we cannot really foresee cyber risk coming, but we can sort of assess the preparedness of financial institutions and key financial market infrastructure, to cyber risk. And I think there's some work going on in this area. So, for example, the banking regulators have been doing this thing called risk mapping, basically understanding, how different banks are dependent on which supplier of software, which supplier of network, AI, cloud computing, etc., and understand the interdependency. And that interdependency obviously is crucial to understanding the scale of potential cyber attacks. But I think overall, more work can be done in mapping out the vulnerabilities and just understand which types of institutions may not be ready for cyber risks.
Thank you, Jason. A little add-on to this question, which we just received in the chat. Do you think that countries that have less sophisticated, less developed markets, financial markets and instruments are more protected, less influenced in such increased uncertainty and risk? So are less developed financial markets more robust to failure of infrastructure or so on?
In terms of cyber incidents, I'm not sure, and if I were to venture a guess, the analogy that I would use is, in digital assets, if you have a cold wallet, right, then it's more safe from sort of attacks and incidents. So I guess there is an analogy there for the financial system as well. However, I would also point out that, when it comes to the impact of uncertainty and tightening global financial conditions more broadly, even less developed countries feel it pretty significantly, right? And that's because less financial development is quite often highly correlated with reliance on external financing. So I showed a chart on frontier economies that maturing. A lot of these frontier economies, because they don't have domestic financial markets, they can only borrow from abroad in dollars. And it is during times when global financial markets are in upheaval when these countries feel the most impact, right? So I think we should be a bit careful in thinking that, less sort of developed markets, less connected to the world, are more insulated from these type of shocks.
Thank you very much, Jason, for your excellent presentations and for the many questions that you answered. Let me now turn to Davide. Davide, you're in charge of the IMF's fiscal monitor. Its overarching theme this time is fiscal policy under uncertainty. What does the current environment imply for fiscal policy and sovereign debt sustainability? Over to you.
No, thanks very much, Ernest. Good afternoon, everybody. Today I'm going to present the fiscal monitor that has been just released a couple of weeks ago. In detail, I'm going to present two chapters. The first is the Conjunctural chapter that will give you a flavor of how the fiscal outlook look like. And then we'll zoom in on one important chapter that deals with political economies of reform, in particular major reforms to key expenditure reforms that are subsidies and pensions. The fiscal outlook is also complicated following what Deniz and Jason have mentioned. We've seen that economic activity has been downgraded in many countries. We see high elevated uncertainty. But we also see that financial conditions are becoming much more volatile. Focusing on more debt, sovereign and variable in terms of financial conditions, there are two elements which are important. One is that if you look at the bond yields of key safe haven or key systemic countries, you see that these bond yields have increased. And second, which is a source of concern, or at least a source that is complicating the fiscal outlook, is that while spread have been a sort of decline in emerging market vis-a-vis both the US and the euro, we've seen that now spreads are coming up. So in other words, interest rate in emerging market are likely to increase, because the increase in bond in key systemic economies, but as well as a source of risk. In addition to this sort of factors, challenges that are affecting the fiscal outlook, there are also two which are more medium or structural. One that applies more to advanced economies, which is defense spending. We've seen that the base dividend sort of declines significantly over the course of the years. Many countries have as their own objectives, including Europe, to increase defense spending. So this will generate additional spending pressures. And then if you look at the emerging market, one key factor, as I will show you later, is that foreign aid has been declining. Historically, it's been a trend declining, which means less resource for financing for social expenditure, for financing for investment, which complicate the outlook for many emerging markets and developing. So as all these factors are happening at the same time, according to the WEO reference point, what you see is that fiscal adjustment has lost steam. We have predicted less fiscal adjustment than we were predicting last time. In the case of advanced economies, the primary balance is sort of flat. The same also for low-income countries. We project a rather soft or flat primary balance. Only for some emerging markets, excluding China, we see the primary balance is likely to turn to converge to sort of zero and to put debt more significant on a stabilization path. However, this primary balance, this fiscal adjustment in many countries are not sufficient to stabilize debt. And if you look at the debt evolutions, you see that the debt now is high, is increasing, and is projected to reach 100% of GDP by the end of the decade, which is even higher than the peak that we observed during the pandemic. This is per se is a sort of concern. An additional sort of concern, which is goes in hand in hand, is that something that also Deniz has mentioned. If you look at the interest expenses, either as a share of revenue or as a share of GDP, they are projected to either increasing or stay high over the projection periods, which clearly put a strain in public finance for many countries, especially low-income countries and emerging markets. Now, let me zoom a bit on the specificity of this pattern. Usually, when you think about debt, there are very heterogeneous patterns. Most of the increase is driven by 30% of the economies, which represent more than 70% of global GDP. And most notably, there are two economies that are really driving the upward trajectory in debt. One is the US and the other is China. So let me zoom in first talking about the US. In the case of the US, 2024 seen an improvement in the fiscal balance. What you see, so the deficit has slightly increased, and most of the increase is due to interest rate expenditure. And this is something that is an important element to consider when we think about the US outlook. You've seen that the US 10-year Treasury has increased. Part is due to factors that are associated to what is called the risk-neutral yields, so economic conditions, etc., etc. But more recently, what we've seen is also an increase in the term premium, and expectations of further debt are playing an important role. For 2025, in the case of the US, we project fiscal positions to slightly improve, mostly on the account of tariff revenue. However, the fiscal outlook for the US is very, very uncertain beyond the consideration that Deniz has mentioned regarding the tariff evolutions. And indeed, some of the uncertainty really is associated to what is happening with the level of tariffs, and therefore with the tariff revenue. And another, it really depends on most of the policies that will be, on fiscal policy that will be implemented in the next month. So in other words, the current baseline doesn't have any measures that are currently under discussion under Congress, and this can shape significantly the outlook going forward. An interest point is that debt, in the case of the US, is projected to rise over time. What we've seen, and is an element that is key when you think about interest rate debt, is that if you look at this is the right chart, if you look at the sensitivity of future debt and how future debt is likely to impact interest rate, you see that this sensitivity has been quite strong in the early 2000s. Sort of became very much muted in the periods of the zero lower bound, but most recently has started to rise again. In particular, the estimate here will tell you that if debt is projected to increase by 10 percentage point to GDP, the yields will increase, but the 10 years will increase by about 60 basis points. Taking these values as face value will imply a significantly worsening dynamics of debt in the case of the US. Now let's go to the second largest economies that drives the impact on further debt. What we've seen in the case of China is that the fiscal deficit has increased almost by 0.6 percentage point in 2024. This was mostly due to declining revenue. In this context, we see that budget execution has been slow, and new issuance, new bond financing vehicle has actually been sort of restrained. For 2025, fiscal policies is expected to be expansionary, to boost consumptions and to boost demand more broadly. This is in some sense, at least in the short term, will also help to address some of the inflationary pressures that we have seen in China, but it's going to also affect significantly the fiscal outlook going forward. And again, as well for the case of the US, there are significant uncertainty regarding tariffs and the possible implication on economic activity and therefore on the path that going forward. Now, going back to advanced economies, there is where there is a significant heterogeneity. There are sort of two commonality in terms of factors that are likely to shape the fiscal outlook going forward. One is increasing in-term spreads. We see that these term spreads have been on an upward trend and are likely to continue like this, which is the first charts. We didn't see any significant change in yield to maturity in terms of bond issuance, but as I mentioned at the beginning of the presentations, spending pressure are likely to become larger over the medium term. And especially in the case of many European countries, some of them are already announced, some of the measures that, again, they are not in the baseline. Additional spending pressure in terms of defense or in terms of additional investment are likely to further increase deficit, if not restrained through either prioritization of spending or increases in taxes. Going to emerging market low-income countries, there are really like two sorts of things that are driving the fiscal outlook going forward. Many of these countries are projected under the reference point to debt to stabilize, but there are two sorts of risk. One is due to the increasing spreads that we've seen recently. And as Jason mentioned, high financial volatility, high uncertainty can generate these increasing spreads, especially for countries that have high debt. And he mentioned like also some countries that were more fragile, like the frontiers economies. And second, something that is going to affect a lot going forward, especially for low-income countries, is official development assistance and foreign grants more broadly. They've been on a steady declining trend. In the case, for example, of the average low-income countries, they move from 1.5% of GDP back in 2010, and now they are projected to almost 0.5% of GDP by 2030. Given the relatively low amount of domestic resource mobilization in this country in terms of tax revenue, this difference of 1 percentage point is something that is very important when you think about the spending needs that these countries they would like to use for social spending as well as a public investment, either in human and physical capital. In all these three presentations, I think a key theme is risk and uncertainty, and also the risk to the fiscal outlook have worsened. And they worsened for 2-3 sort of factors. The first set of factors are factors that have worsened, let's say, up to 2024, both in terms of economic factors, in terms of deficit, in terms of bigger growth, and a very similar toolkit that Jason presented in terms of growth risk. Our debt risk framework suggests that risk to the fiscal outlook, to the debt outlook, are skewed to the upside. And indeed, if you see the 50th percentile, the 95th percentile, you see that the 95th percentile is significantly lower than 50 percentile, suggesting indeed the skewness. And more important, what our estimates suggest is that in a severe scenario, public debt could almost reach 117% of GDP. This number is quite striking. It's about 20 percentage points higher than currently in the reference points in the WEO, and a level that is not ever seen in history since the World War II. Again, it's a risk scenario, but we know that sometimes risk scenario materialize. Our debt risk has worsened compared to the October by almost 2 percentage points. And most of the factors that are explaining this difference, again, based on estimates of 2024 only, is higher primary deficit, higher debt, and tightening financial conditions. This is a sort of starting point, the way that we think about risk to the debt outlook. There are two sources of risk that materialize early in 2025. The first is a factor that Jason mentioned, and is also a theme in the analytical chapter of the GFSR, as well as in the fiscal monitor, which is economic uncertainty risk. What we see that is that economic uncertainty has a significant effect on economic activity. It boosts debt quite a lot. Our estimates suggest that a large increase on economic uncertainty, about 1 standard deviation, could increase the debt to GDP by about 2 percentage points, at impact almost about 4 percentage points after 4 years. This effect, again, is quite sizable. It also, we see that the economic uncertainty affects much more the right tail of the distributions rather than the left tails. In other words, this increase in economic uncertainty is likely to push up debt, but also make the level more risky, so making the distribution of debt more skewed to the right side. What we see is that the impact is a sort of similar for advanced and emerging market economies. There are two differences. One is that in the case of advanced economies in the past, this increase in economic uncertainty, especially those related to conflict, has been associated with higher defense spending, so higher defense spending in advanced economies. While in emerging market, what you see is that revenue tends to decline a bit. The revenue loss tends to be slightly larger than advanced, and this is speaks to the fact that these countries, in terms of output impact, are more affected. Another factor of source of uncertainty is affecting the outlook is tightening and more volatile financial conditions in the US, including on US spreads. Our fiscal monitor typically shows that when US yield interest rate increases by 100 basis points, there's almost a one-to-one pass-through with the yields in other emerging market economies. Here in these two charts, we are showing an effect not on the first moment, so not on the effect of the high yields, but the volatility of bond yields. And our results should suggest that a significant increase in US financial volatility, about 2 standard deviation, which is quite significant and similar to what we have seen in the recent periods, will increase by almost 30% bond volatility in emerging market, and also will lead to softening commodity price. And the effect of commodity price is bad on net for some important countries, but in the case of many oil exporters, has a significant impact on not only economic activity, but also in the source of revenue. And finally, these factors, as well as potential fiscal slippages, are likely to increase interest rate in many emerging market low-income countries. And this is really something that affects not only debt sustainability, but is also likely to affect the composition of spending that these countries will have to face. So in a situation of high interest rate, the countries are likely to prioritize spending, sometimes to cut the spending. Our analysis shows that 100 basis point increase in interest rate in this country that is driven by increase in interest rate in systemic economies is often associated with a significant decline in social benefits or in public investment. But in the case of public investment, for example, by 0.2 percentage point, which given the level of public investment, the effect is actually quite large. For the median economies will be about 5%. And you see even larger declines in terms of social benefits, spending for household, spending for the poor. So this is something of concern. So our key message that will go by in the detail is that given this high uncertainty, fiscal adjustment done in a medium-term, credible medium-term fiscal framework is of paramount importance. This is especially in a situation where we see that the amount of countries that will need to adjust to stabilize the debt has been increasing, as is shown in the left chart, as well as the amount of deficit that is needed to stabilize debt has also increased recently. This fiscal adjustment will have an important role to play in reducing debt. Our analysis shows that this fiscal adjustment are very useful not only to bring the debt down, but also to reduce uncertainty about the future debt evolutions. In other words, if you combine these two effects, the effect on the level and the effect of uncertainty, the bottom line is that the fiscal adjustment, they are going to reduce this debt risk quite considerably. In our baseline, we see that one percentage point of fiscal adjustment can reduce the debt risk by almost 1.2 percentage point. And this effect tends to be usually larger in countries with sound fiscal framework, with countries with fiscal rule, because the existence of this framework will help to anchor the fiscal adjustment, reduce fiscal uncertainty, and is typically associated indeed in a reduction of interest rate costs or spreads in the aftermath of the fiscal adjustment. So let me summarize with the key conclusion of the main chapter. As I mentioned, the key message in a situation of high elevated uncertainty is for many countries to build the fiscal buffer. In many countries, a gradual fiscal adjustment within this medium-term remain essential. It's important to pace the timing as well as the size of debt reductions with the economic growth, and therefore should be tailored to country-specific conditions. In the chapter, we go about some of the measures that a group of countries could implement. For example, in the case of advanced economies, there is a significant scope to reprioritize the spending, advanced pension, is something I'm going to talk a bit soon, and the tax reform in countries where taxation is relatively low. In emerging market, there are two priorities. One is really improve revenue administration, so the revenue side, and the spending side, improve spending management, spending efficiency, but as well as phasing out energy subsidy. That again is something that I'm going to talk. And finally, we've seen that many countries are considering announcing measures to potentially soften the potential impact of tariff. Our recommendation there is that if necessary, this support to communities should be timely, targeted, and very temporary. In the case, and should also kept in lines with the fiscal space. So in other words, countries that have fiscal space, they can implement these measures by increasing deficit. In countries where there is no fiscal space, these measures has to come either with spending repatriation or increasing taxes. And finally, and this will help me to bring you to the next chapter, advancing fiscal structural reform is key in this context of high uncertainty and weak growth and high debt, because these reforms will help to boost growth and also tend to mitigate debt growth trade-off. So let me jump now to the second chapter, which deals on the political economics of the reforms. So we know that I just mentioned that there are two important reforms, pension and subsidies. Pensions reform are especially important for advanced economies. Just to give you an idea, pension spending in advanced economies account for 8% of GDP, and is projected to increase even by 2 percentage points in the next decade. If you look at the spending on subsidies in emerging market and low-income countries, they are about 1.5% of GDP, and they overcome most of the expenditure that is devoted for social assistance to protect the poor. So this spending reform have the potential to generate significant fiscal saving, but also to boost growth. However, while it's often recognized that these reforms are important, they often are difficult to pass. There is typically strong oppositions about this reform. While this is the case, in the case of subsidies, because they are broad-based, the cost is broad-based when you remove subsidies, and this is really in the short term. And in the case of retiree, in the case of pension, it typically affects a specific group, which tends to, of course, mobilize voters or mobilize against this passing of the reform. And in both cases, this reform sort of create concern about fairness of the policy that countries often implement. So how can countries can pass this reform? To answer this broad question in this chapter, we do significant work. First of all, to understand what we know about energy and pension reform. What we look in the chapter is we construct a new database to try to shed light on the historical experience the countries have done with the energy subsidy and pension reform. What are the typical features of this reform? Where do they happen? Where do they happen more systematically? In which periods? The second element is what drives the fact that these reforms can be implemented, but also that this reform can be durable. Importantly, what is the sentiment or the stakeholder perception of the reform around these to measure expenditure programs. And finally, really how we can improve, how government can improve sentiment towards reform and make sure that these reforms are implemented. So this has been a work of a large team across with collaboration also across the different divisions and departments, and that's consisted of really three blocks. The first block is constructing a new database of reform measures, which will soon be available in the IMF, a database about pensions, a database about subsidy reforms. The case of pensions will incorporate about 160 countries, and will go from 1960 to 2023. In the case of subsidies, is based on IMF's report. The coverage is even larger, it's 170 countries, and it covers almost the last 25 years. This is a first data contribution. A second important data contribution is that we construct a new measure of sentiments. And this is done using AI, and applying a sentiment analysis to factive articles. We have about 2 million of factive articles, 1.4 million of factive articles around major steps for energy subsidy reform, and about 600,000 in the case of pension reform. And we identify sentiment from this reform for key stakeholders. So we look at the sentiment of civil societies, sentiment of unions, sentiment of household, sentiment of opposition parties, sentiment about government, and so on and so on. And we see how these reform affect sentiment and which type of policy measures can affect this sentiment that we construct. Now, let me give you a very broad overview on how these pensions and subsidy measures or reform look like. Starting with subsidy, what you see is and indeed there was something I'm surprised is that actually subsidy measures are frequent. There are about 0.2 average number of measures per countries, and they tend to happen often, most often in emerging market and low-income countries. Interesting, these measures they tend to pick up when oil price increase, because when oil price increase, fiscal policies became under strain, so countries they tend to implement much more measures, price measures. However, this picture at the first glance seems rosy, but actually it's not rosy at all. And the reason is that most of these measures are ad hoc, very minor, often short-lived, and in some cases, even reverse. So countries that do this reform, they typically do ad hoc measures. What we typically see is that most of the measures, they just last 1 month, and then in some cases are paused, or in some cases are reversed, and they are not durable. And why countries implement this reform? Indeed, this issue regarding fiscal consideration. Most of the measures that countries implement these measures is really due to fiscal concern with when oil price indeed goes up, fiscal concern tend to increase. The same story, but for other group of countries, looks also for pensions. Pensions, again, are also frequent, but especially in advanced economies, but with 2 exceptions. First of all, most of these special measures are ad hoc. And second, when we think about pensions, the first things that people come to my mind is a change in pension age, in age of retirement. And it's something that also Deniz discussed in the Untitled Chapter of the WEO. Well, this reform accounts for a very, very limited amount of pensions measures. What the countries typically do, they change some parameters in the pension benefit system. But they don't really undertake pension reform that are significant and durable. And when they do very gradually over time. It takes time before this change in retirement are implemented. And again, similar for subsidy, we see that most of these countries implement for fiscal consideration. So what drives this reform? In the chapter, we look at a variety of factors, macroeconomic factors, institutional political environment, and then we look at sentiment. And what we find importantly is that while all these factors matters a lot, sentiment matters the most. So in other words, really sentiment matters. We see that sentiment by key stakeholders, union, civil society, household, and opposition parties is the main predictor for advancing a pension reform. And is the second predictor beyond full price to advance energy measures reforms. Importantly, what we see, we also identify some sort of causal effect that this sentiment not only helps to predict reform, but also increase A, the probability of the reform, and B, the magnitude of the reform itself, and C, the durability of the reform. So stronger sentiment often implies that these reforms are larger and these reforms are much more durable. So what drives sentiment? In the chapter, we see that both for pensions and subsidy, reform designs matters a lot. A first element, what we see is that when these reforms are, when possible, when they are implemented in a gradual way, sentiment tends to be negative. Here we're going to show 2 charts. One is the evolution of sentiment after a reform announcement, in the case of small changes in the measures, or in the case of large changes for subsidies, while for pensions, we look at age increase versus non-age increase. And what you see is that large change are often associated with much more negative sentiment rather than a gradual approach. Another important consideration is the timing in the economic conditions. countries that pass this reform in periods of relatively higher growth, typically the sentiments tends to decline considerably less. A third lesson is the role of accompanying measures, especially for subsidies. We see that when countries implement subsidy measures, but either have social protection systems in place to compensate losers, which most of the times are poorer households, or actually they increase either redistribution policies or transfer, we see that the decline in sentiment is not statistically significant. And the same actually happens for pension in the case of when targeting specifically retiree, and this, for example, has been policies that Australia has done when has passed pension reform. And finally, and one element which is very much important is government accountability and strong institutions. Having strong institutions helps to build trust for key stakeholders that the fiscal savings from this reform are wisely spent. Indeed, we find that countries with either the government is highly accountable, or in countries where there's very strong fiscal council that tends to manage in a proper way this fiscal saving, we see that the saving and we see that the sentiment does not decline. And finally, discuss some of the features that often countries implement the reform. We say, it's okay, ideally you should do gradually, ideally you should do in periods of high growth. Sometimes you should build trust. Often, however, countries are not neither of these three characteristics. Sometimes they face significant fiscal needs. They have to reform swiftly. Sometimes they add to the reform in economic conditions. And then what we find is often that the strategic communication and engagement with stakeholders is key. And indeed, there are many countries, example that we cover in the fiscal monitor that can shed light how to do these policies in this challenging time. For example, a policy in case of pensions, in the case of Uruguay, a strategic combination was super important to basically present the increasing retirement age as a way to keep the same level of benefits in terms of pensions. Another thing that, for example, again, other countries has done, like Germany, or again, for Uruguay, for example, for pensions, is to create bipartisan pension commissions where we'll have the key stakeholders to interact with the authorities when we're thinking about the reform and indeed the stakeholder concern. So what sentiment really matters for reform implementation and durability, and the countries have sometimes the toolkit to foster sentiment. The timing, the designs of the reform matters, the accompanying measures matters, strengthening governance and trust, and strategic communication. These are 5 key elements that can really boost the sentiments and therefore reform durability. I stop here. Thank you.
Thank you very much, Davide, for this excellent and comprehensive presentation. We have, I think, 5 minutes left until the end. So I think a number of interesting points were made by you, and of course these trigger even more questions. One question that I would have is whether you have done any thinking on the optimal timing of compensatory measures. I mean, the intuition would be you need to have them together, the measures and the compensation. If you separate them, let's say, like in a case in Austria, you do the compensatory measures 2 months ahead, and then you do the reform or some other measure, then the connection is not made by people, and they just see the negative and have forgotten about the positive compensatory measure. Then another question I would have is, cross-country differences. It seems to be that in some countries reforms are more easily accepted than in other countries. Is there a role of culture? Can culture be changed over time, and through what measures? Does the level of education play a role for a nation as a whole? And then the third issue that came up to me, to my mind, was, energy subsidies. In many European countries, when the energy crisis hit a couple of years ago, there was the obvious trade-off between letting energy prices play out or limit them. Limiting them would then have negative effects on adjustment processes towards renewable energies, energy saving, and so on, and environmental objectives. So there are obvious trade-offs. What's your thinking on this?
No, thanks very much, Ernest. So thanks for this question that will help me to develop some point. On the timing, I think there are two considerations. I think it's very difficult to identify what is the optimal timing. The first consideration is the element that you mentioned. You want that the stakeholder sees these transfers in a sort of accompanying measures to the reform. So he wants like this to be a sort of package. In this one, it's okay, you do subsidy, but at the same time, you are creating a system where you're protecting my income or my welfare for any loss. And I think this is very important. There is also whether and this probably is more relevant for advanced economies to have accept the same time. In some countries, emerging market, I think a lot of concern when countries they start to do this sort of reform is because the initial level of social assistance is very low. So they feel that when the countries is going to do a reform that is going to increase prices, they will have significant losses just because the initial level of social assistance is small. And actually, our analysis revealed that both things matters. Both the initial level of social assistance matters, but also the change in transfer that is done at the same time to the reform. So both elements matter. On the cross countries, I think our analysis revealed that sentiment typically turns less negatives in societies where they have characterized by less inequality, in societies that are characterized by higher trust to institutions and government. And I think it's because individual feels that these measures are not measures that penalize only them, but they see this measure are important for fairness, and therefore there is not a negative reaction in sentiment. And also in the case of trust, if they trust the government that they're doing something first of all for their own welfare, but also that these additional fiscal savings are really well spent, and they are not channeled only to specific interest group. And finally, on your first point, I think you really touch upon an important trade-off. I think at the time, what the IMF has seen is okay, we are in an exceptional energy price shock, cost of living crisis, so these measures could be considered as a part of the response, but they should be targeted, timely, and temporary. Indeed, the temporary is important to not avoid any sort of effect of misallocation of resources, also including towards the green transition. So this was our suggestion, our thinking to really mitigate this trade-off in having these measures in a really targeted as well as a temporary nature. Thanks.
Thank you very much, Davide, for your excellent presentation and for your answers. Very clear. I think this concludes our SUERF-BAFFI Bocconi lecture on key insights from the IMF's April 2025 World Economic Outlook, Global Financial Stability Report, and Fiscal Monitor. A great thank you to Deniz, Jason, and Davide for your insightful presentations, for answering our questions. It is really comforting to see, if I may say that competent and reliable institutions like the IMF keep up global dialogue among experts and political decision makers based on facts and sound analysis, also in turbulent times. Thanks to all of you for your interest and for your questions and comments in the chat. Bye-bye and take care.
Bye.
Thank you. Bye.
Thank you.